Welcome again to my channel, The Hidden Wealth Journey. You need to watch this if you struggle with understanding how to start investing in stocks. Now, you might be thinking, investing? That sounds complicated and risky. Trust me, I get it. But that's why I'm here to break it down into simple terms and show you how to get started, even with a small amount of money. Chapter 1: Understanding the stock market. What beginners need to know. Before we dive into the how to, let's start with the what. What exactly is a stock? A stock represents a tiny piece of ownership in a publicly traded company. Think of it like buying a slice of your favorite pizza place. When you buy stock, you are becoming a part owner or shareholder. The stock market is a giant marketplace where stocks are bought and sold. It's where supply and demand come into play. When more people want to buy a stock, the price goes up. If more people want to sell, the price goes down. It all comes down to a company's performance and future potential. If a company is doing well, investors get excited and pay more. If a company is struggling, its stock price might take a hit. Buying a stock is betting on the future success of that company. Chapter 2: Define your goals. Why you're investing in the first place. Before buying your first stock, let's talk about your financial goals. What are you hoping to achieve through investing? Are you saving for retirement, a house, a vacation, or building a safety net? Knowing your why shapes your investment strategy. Investing without clear goals is like sailing without a destination. Take time to think about your financial aspirations. Chapter 3: Choosing the right brokerage account. Where to buy your stocks. Okay, so you understand the basics of the stock market and you've defined your financial goals. Now, it's time to choose a brokerage account, your gateway to buying and selling stocks. Think of a brokerage account like your online investing hub. It's where you'll place trades, manage your investments, and track your portfolio's performance. Now, with so many brokerage options out there, choosing the right one can feel overwhelming. But don't worry, I've got you covered. Here are some key factors to consider. First up, fees. Every brokerage charges fees for their services, so it's essential to compare pricing structures. Look for platforms with low trading commissions. That's the fee you pay every time you buy or sell a stock. Some brokers even offer zero commission trading, which can save you a significant amount of money, especially if you plan to trade frequently. Next, consider the platform's ease of use. Is the interface user-friendly and intuitive? Can you easily find the information you need, like stock quotes, research reports, and your account balance? Let's talk about the different types of stocks you can invest in. It's not a one-size-fits-all situation. The most common type is common stock. Common stock gives you voting rights and dividends. Preferred stock is different. Preferred stockholders get priority on dividends. Stocks can also be categorized by sector or industry. Tech stocks like Apple or Microsoft, healthcare stocks like Johnson & Johnson, and consumer goods stocks like Procter & Gamble. Diversify your investments across different industries. Understand dividend-paying stocks. All right, so you're eager to start investing, but you might be wondering, where do I even begin? Well, for most beginners, I recommend starting with low-cost index funds or ETFs. also known as exchange-traded funds. Think of index funds and ETFs like baskets of stocks that track a particular market index, like the S&P 500 or the Nifty 50. Instead of buying individual stocks, you're essentially buying a tiny piece of hundreds or even thousands of companies at once. This provides instant diversification, which is crucial for managing risk. Remember how we talked about not putting all your eggs in one basket? Well, index funds and ETFs take that concept to heart. By spreading your money across a broad range of companies, you're less vulnerable to the ups and downs of any single stock. Another significant advantage of index funds and ETFs is their low cost. Because they track an index, they require less active management, which translates into lower fees for you. And over time, those lower fees can make a substantial difference in your investment returns. Let's talk about one of the most crucial concepts in investing: diversification. You've probably heard the saying, don't put all your eggs in one basket. Well, in investing, diversification is that basket. It's about spreading your money across different assets, sectors, and geographies to reduce risk. Think of it like this. If you invest all your money in one stock and that company goes through a rough patch, your entire portfolio takes a hit. But if you diversify your investments, the poor performance of one stock is offset by the potential gains in others. So, how do you diversify effectively? Start by investing in different sectors or industries. Don't just focus on tech or healthcare. Spread your bets across various sectors like consumer goods, energy, financials, and so on. You can also diversify by investing in different asset classes. While stocks should form the core of a long-term investment portfolio, you can also consider allocating a portion of your money to bonds, real estate, or even commodities. Each asset class has its own risk and return characteristics, and by diversifying across different classes, you can potentially smooth out your portfolio's volatility. Chapter 7. Research is key. Don't just invest blindly. Okay, before you hit that buy button, it's crucial to do your research and understand what you're investing in. Don't just blindly follow the hype or rely on someone else's recommendations. Take ownership of your investment decisions. Now, researching stocks might sound intimidating, but it doesn't have to be. Start by looking at the company's financials. You can find this information on the company's website, financial news websites, or through your brokerage account. Look at their revenue growth, profitability, debt levels, and cash flow. These are all essential indicators of a company's financial health. Next, consider the company's competitive landscape. Who are their main competitors? What are their strengths and weaknesses? Chapter 8. Think long-term. It's a marathon, not a sprint. Now, when it comes to investing, it's essential to adopt a long-term mindset. The stock market is not a get-rich-quick scheme. It's a marathon, not a sprint. Trying to time the market or chase short-term gains can be tempting, but it's often a recipe for disaster. Remember, the stock market will always have its ups and downs. There will be periods of exuberance and periods of fear, but over the long run, the market tends to trend upwards. By staying focused on your long-term goals and riding out the inevitable market fluctuations, you're more likely to achieve financial success. One effective strategy for long-term investing is dollar cost averaging. This approach involves investing a fixed amount of money at regular intervals regardless of market conditions. By doing so, you're essentially buying more shares when prices are low and fewer shares when prices are high. which can help lower your average cost per share over time. Chapter 9: Monitoring your investments, staying on top of your game. Alright, once you've invested your hard-earned money, it's essential to monitor your investments regularly. Now, I'm not saying you need to obsessively check your portfolio every day. In fact, that can be counterproductive. But it's good to review your investments every few months to ensure they're still aligned with your goals and risk tolerance. Start by checking your portfolio's overall performance. How have your investments performed compared to the market? Which investments have exceeded expectations and which ones have lagged behind? Understanding the winners and losers in your portfolio can help you make informed decisions about rebalancing or adjusting your strategy. Next, revisit your asset allocation. Remember how we talked about diversifying across different asset classes? Over time, your asset allocation might drift away from your target due to market fluctuations. For example, if the stock market performs exceptionally well, your equity exposure might increase significantly, making your portfolio riskier than you're comfortable with. Chapter 10: Never stop learning. The stock market is constantly evolving. Congratulations! You've made it to the final chapter of this beginner's guide to investing in stocks. But remember, this is just the beginning of your investing journey. The learning never stops. The stock market is constantly evolving, so it's crucial to stay informed, adapt to new trends, and continuously expand your knowledge. One of the best ways to stay ahead of the game is to read books, articles, and blogs written by experienced investors and financial experts. There's a wealth of information available online and in libraries, covering various investment strategies, market analysis, and personal finance tips. Another great way to learn is to listen to podcasts or watch videos from reputable sources. Many financial educators and experts share their insights and advice through these mediums, making it easier than ever to access valuable information on the go. And don't underestimate the power of community. Consider joining online forums or investment clubs where you can connect with other investors, share ideas, and learn from each other's experiences. Outro. Start investing today. Your future self will thank you. So there you have it, a comprehensive step-by-step guide to investing in stocks for beginners. We covered everything from understanding the basics of the stock market to choosing the right brokerage account, diversifying your portfolio, researching companies, and developing a long-term investment strategy. Remember, investing is one of the most powerful tools at your disposal for building wealth and achieving your financial goals. It might seem intimidating at first, but by taking it one step at a time, educating yourself, and seeking guidance when needed, you can become a confident and successful investor.